Hello, this is Doug Gerlach from iCLUBcentral and myICLUB.com. Welcome to our Investment Club webinar. Today is October 15th, 2024, not November 2024, but October. Glad you could join us for our presentation tonight on tuning up your investment club's portfolio. I'm going to be reviewing some of my guidelines for portfolio construction and management for investment clubs. And we have 3 clubs that have submitted portfolios, so we will be reviewing those portfolios, and I'll be providing some opinions and perhaps pointing out some areas where improvements could be made. Hopefully these lessons will be applicable to your own investment club portfolios as well as your personal portfolios. This portfolio tune-up is brought to you by myICLUB.com. So all the clubs that are participating are using myICLUB, and I'll be demonstrating the tools that we have available on the myICLUB website for portfolio management and reporting, and that can help you guide your own club portfolio construction. The Handouts tab in the GoToWebinar application is available with a PDF of the slides from this presentation, and you can also type in your questions at any point using the questions box also in the application. In the back office this evening, we've got Triva Dildine, Sean Poreng, and Russell Malley, our 3 of our tech superstars, who are also available to answer questions. So if you have any, please feel free to use that at any point. We'll be taking a couple of breaks, and I'll be monitoring those questions as they come in. So first, I'm going to go over my so-called rules of portfolio construction, especially for investment clubs. I think that investment club success can largely be attributed to having a tangible plan with specific goals that you can utilize to make decisions about what securities to buy and sell and hold within your club portfolio. Clubs that are merely collectors of stocks, as if it's some sort of tchotchke on a shelf, tend not to see the same performance results as clubs that have specific goals and are working towards those goals with respect to the portfolio construction. So rule number 1 is get in the market and stay in the market. Better Investing suggests that it's possible to be successful over the long term when investing in individual stocks by remaining 100% invested all the time. Don't sit on cash, don't bank your cash. If you have withdrawals, some clubs like to keep a cash reserve so they can more easily pay out club withdrawals, member withdrawals, but usually most of those clubs could handle those withdrawals by raising cash, by getting rid of their underperforming stocks, or transferring shares of their biggest winners to those withdrawing members. Market and economic cycles will come and go, will rise and fall, and these will give you opportunities over the long term if your approach is truly long term to buy into the market and buy individual companies at attractive prices. One of the key reasons Better Investing suggests that you don't try to time the market is that it's impossible. Most of the market's gains in 2023, for instance, came in just 6 days. So if you didn't have the foresight to be invested on those particular days, you could have missed much of the market's returns in one of the recent years where performance was very strong. And that's one of the biggest risks to your portfolio, is not being in the market when it makes an upward move. So we believe that investment clubs and individual investors are best served by waiting out the market bottoms, the doldrums, the bear markets, the corrections, and staying fully invested throughout all the market cycles instead of trying to guess when it's the right time to get in and get out. Number 2, I really believe that club club portfolio goals are best served by keeping the portfolios simple and straightforward. Not only does this make your treasurer happy, it will actually be more successful over the long term. You won't have problems filing tax returns, and you can utilize the same rules across your entire portfolio if you focus purely on common stocks. So some of the types of investments that we recommend that clubs stay away from include real estate investment trusts, or REITs. These are probably the easiest accommodated on this list. So if you do have them, and if you're aware of the risks and the potential for unfairness for withdrawing members, for instance, and you're aware of the work that it takes to reclassify the quarterly or monthly distributions that REITs make after year end, then it's okay. But if you don't understand the risks, and if you're not willing to do the work, then they're best avoided. Business development companies are similar in that their distributions are often reclassified, and so they're not paying you profits so much as returns of capital in many cases, and they also can become problematic. Any type of publicly traded partnership or a master limited partnership, these are often great for individuals and great for investors who are seeking income, but they have some different tax rules regarding them that make them more complex for investment clubs. Commodities are also handled separately in tax code from securities, and that goes for ETFs, or exchange traded funds that hold commodities and precious metals. So we suggest that you avoid those, and cryptocurrency is also something that we suggest that you avoid. Our tax printer doesn't support them. There are some new ETFs that launched last year that may be accommodated, but there's a lot of uncertainty there. Any ETFs or mutual funds, we also suggest you stay away from, unless you have clear articulated reasons to be in those. If you're merely parking cash in an S&P 500 index ETF, we think that's probably not the best use of your capital, because it's going to create complexity in your tax filings, and it's not giving you the benefits that you perhaps would hope to achieve by parking cash in some sort of entity that at least is gaining exposure to the markets. So if you have any of these securities, we suggest you make sure that you understand the risks. If you're not willing to continue putting your treasurer through the ringer, then we suggest that you sell them before the end of the year, so at least you'll only have one more tax year of difficulty to deal with these types of securities. My third rule is to keep your club portfolios concentrated. Don't hold too many stocks. My minimum of total portfolio value for any particular stock is 3%. My rationale is that if you've got stocks that you own that make up 1% or 0.5% or 2% even of your portfolio, and they perform well, they're not going to have an impact on your total return. That those stocks could double overnight, and your portfolio would see a 1% or a 2% increase. If that holding was 10% or a 9% or 11% of your portfolio and it doubled overnight, then your entire portfolio would be lifted up. So small holdings, you have to have too many of them in order to fill out your club portfolio. Too many of them have to perform well. Too many of them have to be monitored. Too many of them could have potential problems. And so if you concentrate on finding the best of the best of breed, the industry leaders in particular industry groups, your portfolio returns will reflect this attention to excellence. Research shows that 20 to 30 well-chosen high-quality stocks can deliver an optimal rate of risk and return in a diversified stock portfolio. And if you own too many stocks, your portfolio effectively becomes an index fund. And yet you're spending a whole lot of time and expense accounting for individual securities. It would be simply a whole lot easier if you just held an index fund instead of holding 100 different companies. This goes for individual investors as well as investment clubs. Now, if you've got a very large portfolio, greater than $1 million, you've got a substantial number of members in your club, you can exceed this guideline. But if you're holding 60 or 70 or 50 or 80 stocks, that's an awful lot, and there's a lot of detail that you're probably missing with those companies. There's probably a lot of overlap that's happening where you're owning two companies that are highly correlated and operating in similar areas, and so that can impact your performance as well. So the rule of thumb is that by concentrating, you're going to be forced into making good choices about your stock picks, and you will not be making decisions on a lackadaisical basis. The tendency to say, well, let's just buy 10 shares and see what happens. And that tendency over time is just not serving you well as doing the research and saying, well, here is a stock we have a high level of conviction will perform well. As Warren Buffett once pointed out, the best way to invest in a company is to do the research, find the single best opportunity you can, and invest 100% of your portfolio into that one stock. Now, some of you may be going, that seems a little extreme, but you're not Warren Buffett. And his point is that you wouldn't make that investment if you didn't have a high degree of confidence in your research and in the performance that was likely to come from that investment. So if we apply that same level of a search for excellence, of trying to identify an investment in which you are highly confident to a smaller subset of 20 to 30 stocks, then you will be serving this objective and can benefit from it. Now, research shows this graph that shows the total portfolio risk is a function of the number of stocks. The way to read it on the left side is the standard deviation. This is a percentage that reflects roughly the volatility, if you will, the risk of any particular investment. On the bottom, going across, is the number of stocks from 1 to 100. On the left side, you see this 30% standard deviation. If you have one stock, your portfolio has a high degree of risk because it's all included in that one particular stock. If that stock falls in half, your portfolio falls in half. As you add stocks, 2 stocks, 3 stocks, 4 stocks, you see the portfolio risk drops dramatically. As it gets to about 10 stocks, you can see you've reduced the standard deviation of the portfolio from 30% to around 17 or 18%, so significantly dropped it. Now, at 15% standard deviation, that's the level that represents market risk. It can never be diversified. You can never remove the risk of the market risk of a portfolio of stocks. But you can see you can continue to reduce it as you add more and more stocks, as you diversify and diversify and diversify, but you're not reducing it by very much whatsoever. After 20 to 30 stocks, you've maxed out the benefit of reducing portfolio risk by a number of companies. So this is the basis for my recommendation that a portfolio of 20 to 30 stocks works most effectively for a club portfolio. Anecdotally, going back 10, 15 years ago, we did run a mutual fund newsletter in conjunction with BetterInvesting for a time. And one of the key learnings there was that the best performing mutual funds often had a very low number of stocks, maybe 30, 40, 50, 60 stocks in an entire mutual fund, serving hundreds or thousands of investment unit holders in that fund. And this allowed the fund managers to execute a highly articulated, defined strategy without having to, make allowances and add additional companies that didn't fit because they needed to fill out, they needed to invest the shareholder assets in some way. And so it was really enlightening to see these high-performing funds, managed funds, beating indexes on a regular basis because they were small, they were well-defined, and management had an approach and used it. So I think clubs should emulate that particular approach. Number 4 is all about diversification, diversifying by company size. BetterInvesting suggests that you should diversify your portfolio to include small, mid-sized, and large companies. Mid-sized companies are defined as having revenues between $1 and $10 billion, and these are rough targets. BetterInvesting suggests that revenue is a better way of calculating the size of a company as compared to market cap. Market cap measures popularity. Revenues measures size, true size of a business. And so we look at revenues to determine company sizes. If you don't believe in this particular guideline, define your own. Are you going to be satisfied with a portfolio that is 80% mega cap and 20% everything else? There will be times in the market when small company stocks will be outperforming and when small company stocks could be delivering better rates of return. The characteristics of company sizes that drive this recommendation include the following. Now in myICLUB, you will see a micro category. These are for companies that have revenues of less than $100 million a year at the very small end. These tend to be more speculative. Speculation is not a bad thing, but you can't let it run out of control in your portfolio. Micro companies tend to not have a big analyst following. They tend not to have a big support of investors. They simply don't have the float available for institutional investors, and they often run below the radar for individual investors. However, they often have great attributes. Find these smaller companies, they can be a good addition to your portfolio as long as you're willing to wait for them to grow, to perform, and for other investors to catch on. The small and mid-sized company ranges are the sweet spot for total return. These tend to be companies that are growing, generating growth at a higher rate, but they are available for lower PE ratios than the mega caps and large cap popular stocks. And so you have opportunities to buy them, and they often deliver the best rates of return over the long term. Large companies, those with revenues less than 50 billion, greater than 10 billion, often add stability and dividends. These would include what are typically called your blue chip stocks. So these can be good core holdings. These are brand names, often very well-known businesses, and that provides a certain level of support. But you've got to watch out because often those companies don't have the potential earnings power to drive all of the return that you might look for. More of the return might come from dividends, which are taxable at higher rates than capital gains, and so overloading on large company stocks can reduce your overall returns. And then we call out a separate category of mega companies with revenues greater than 50 billion. These can tend to be slow growers. Now, in the last couple of years, the Magnificent Seven, which is made up of mega-sized businesses, has outperformed every other segment of the market just about, and beyond the stock market, and that's just a factor of the way the economy's been going, the way that individuals and retail investors have been approaching the market, the rise of index investing that's driving and holding investment in these mega company stocks at particular levels. Interest in AI that has often been adopted by the Magnificent Seven companies leading the charge into artificial intelligence. So a lot of factors right now have created confluence of drivers that are helping these businesses to outperform. They've cooled off a little over the summer. They're contributing over the last 2 years a significant portion of the S&P 500's total return, but that's not always going to be the case, and there are plenty of times where investing in large and mega cap stocks is not always the best place to be. There's a reasonable level of non-correlation between small and mid-sized companies and larger companies where they don't perform the same in the cycle. So if you overload on those Magnificent Seven stocks, the volatility in your portfolio is going to increase quite a bit as well. You can look at your portfolio beta. Those 7 stocks and other similar mega cap, mega size companies tend to have higher betas, which is great in a rising market, but in a declining market or a flatline market, those companies can create uncomfortable variances in your day-to-day, week-to-week, month-to-month returns that many investors don't like. So this is why when you throw it all together in a pot and mix it all up, you get something that's greater than the sum of all of the parts. Number 5 is to diversify by sector and industry. We use the super sector industry framework as developed by Morningstar, our data service. There are 3 super sectors that sectors are grouped into. These are the defensive, the sensitive, and cyclical. My target minimum is 15% in each of these 3 super sectors. And again, that's a rough guideline, but I think the idea is that if you can spread out into those 3 super sectors broadly enough, in the case of a protracted recession, your defensive company stocks will hold the line for you, while the sensitive and cyclical stocks will be failing a little bit in terms of the economic power of the companies in those super sectors. The sensitive and cyclical will be driving the returns of your portfolio during expansion modes of the economy. And since we have more expansion modes than recessions, it's good to, you can, weight most of your holdings in those sensitive and cyclical sectors. But defensive stocks are a good hedge, a good insurance policy, if you will. And so at any point in time, you should have some reasonable exposure to defensive stocks in your portfolio, just like in any point in time, you should have insurance on your house that covers floods, tornadoes, hurricanes, windstorms, mudslides, fire, and other events that could damage the investment in your property. Now, you don't need to include every sector that's out there, the 11 or 12 sectors that most data services categorize companies into, but it can be a reasonable aim to include almost all of them. Real estate, energy, and utilities are often don't fit the BetterInvesting model, don't fit the SSG model very well. So either you suspend your disciplined approach for the sake of diversification, or you avoid those in your portfolios. So that's for you to decide, but something to think about. It's always good to include many divergent industries as well. There are 148 different industry groups, but some of those overlap quite a bit. There is a semiconductor industry group, and there is also a semiconductor equipment makers industry group. And as you might imagine, any factors affecting the semiconductor chip market will impact both of those companies to a similar degree. And so loading up on 2 companies from those 2 separate industries is not providing the maximum diversification that you might be expecting. My rule of thumb is that no industry group should be less than 3% as represented by a single company, or more than 15%. That's a rough figure. Here are the super sectors and the sectors in our data service. The cyclical super sector includes the basic materials, consumer cyclical, financial services, and real estate. Um, um, Sectors. The sensitive supersector includes communication services, industrials, technology, and energy sectors, and the defensive supersector includes consumer, defensive, healthcare, and utilities. And as you look through these, you can get a sense that we're talking about the exposure to economic trends, the cycles of the US and global economy of contraction, expansion, or recession and expansion over time. That's been going for 200 years, and those cycles do continue. They change over time, they lengthen, but we do still believe that we will have recessions in the future. We haven't had one now since the brief recession of 2020, before that in 2009, but we would expect to have them again. And what happens in recessions is that companies tend to see their fundamentals fall off if they're sensitive or cyclical, and their stocks may get squeezed, and investors don't like that. And so it can cause you to take action when you don't need to. Number 6, focus on the growth. The stock selection guide is primarily a tool to identify growing companies that are selling at reasonable prices. And so the tool will help you build a model for what you might expect if a company is able to grow at a particular rate over the long term and sell at within a particular range of PE ratios as determined by the company's track record in the past, industry trends, and your expectations for the future. And there are 3 components of total return that you can identify on the stock selection guide, BetterInvesting tools. One is the capital appreciation that's driven by fundamental growth. That is what BetterInvesting suggests is the key total return objective. In other words, you find companies that are growing their sales and earnings. When they do grow their sales and earnings over time, their share prices will increase. As their share prices increase, you receive the benefits of the capital appreciation of those shares. Now, if you can find those companies and buy them when they're selling at discounted prices, you can also benefit from PE ratio expansion, the second component of total return. So you get a little boost to your revenue because you bought wisely, you bought at inexpensive levels. And 3, for those companies that do pay them, you can receive a little bit of income from dividends. Now, dividends and growth from a fundamental perspective don't always align. Companies that are growing more quickly than other companies tend to be using their retained earnings instead of paying them out as dividends. So if you're looking for dividends in your portfolio, you're going to be giving up capital appreciation. That may be a worthy trade-off, but in an investment club, unless all of your members are at the same stage in their life cycle of investing personally, you're better suited driving the club portfolio as a total return vehicle driven by capital appreciation primarily. If you stray from those priorities, you might see your portfolio not beat the S&P 500 without an accompanying decline in volatility, which might be your aim. A lot of investors say if I buy companies that are paying high dividends, then I'll see less volatility in the short term, and that may be a worthy goal again, but not if it causes you to underperform the broader market when you've still got decades to go to reach your financial goals. My general guideline is seeking minimum average earnings growth of 10 to 12% for the stock companies in your portfolio, and don't overly focus on dividends as an income generator. If you were running a mutual fund, your mutual fund um, uh, uh, investment policy statement would define the approach, the types of stocks, and the manner in which the fund's assets were to be invested. And your club should follow a similar practice. And so that's why I think this multi-cap growth approach works best. And when it's articulated and utilized, can help clubs outperform the broader market. Now, number 7 is that you should attempt to balance risk and return, or at least be aware of it. Risk and return go hand in hand. You can't accept higher return without accepting higher risk. You can't reduce the risk in your portfolio without accepting reduced returns in most cases. And one way we can measure risk in your portfolio is by looking at beta. Beta is a figure that typically is calculated over 5 years of a security's price, and then compared to an index such as the broader market. So a beta of 1 says the portfolio, for an entire portfolio, would reflect that portfolio has sensitivity or volatility equivalent to the broad market. If it's greater than 1, there's more sensitivity to volatility risk. If it's less than 1, there's less sensitivity to volatility risk. And there are negative betas for assets such as gold, for instance, that reflect an inverse relationship between the market and a particular security or commodity. So another way of looking at this is that if your portfolio beta is 1.1, that is saying that historically your portfolio has exceeded the market's direction in either up or down by around 10%, right? And so that is a good place to be. If the market will generally be moving up, so we focus on the upside. Don't worry so much on the downside. But if your portfolio is 0.9, well, that's saying that every time the market went up, your portfolio didn't go up as far as the market. It also didn't go down as far as the market when the market went down. But since that's not the default of most of the periods in which you're investing, that is not a great place for someone or for a fund or a club to be at when they're trying to build returns over the long term. So I think a weighted average portfolio beta, which we will calculate in myICLUB, of around 1.1 is a good target. I don't necessarily think that you need to work towards it especially, but it is something to be aware of. And again, just keep in mind, you want to be performing a little bit more than the market in rising markets. And so if your portfolio beta is too much more than 1.1, then you can see some uncomfortable swings that perhaps your members are not very not pleased to see. And if your portfolio beta is less than 1, well, maybe you're playing it a little too safe in the market compared to history. History doesn't predict where the market is going, where security is going, but when you look at it in the aggregate, in the context of an entire portfolio, I think it can give you some insights and maybe suggest that you're paying attention to the wrong things for a truly long-term focused portfolio. And number 8, maintain the management of your portfolio. We do not espouse a buy and never sell approach to the market. We do not suggest that you should buy and hold stocks forever. There will be companies that will underperform. There will be companies that hit roadblocks and temporarily face difficult times. Often the inclination for long-term investors is to hold on to those stocks, but perhaps too long, when they might be better served by replacing those securities with assets that have higher levels of quality and higher rates of potential return. The market tends to remember when companies don't perform well, and then will avoid them for much longer than perhaps is due to those company management teams. But it's better to take action probably sooner or more often than your instinct tells you in a long-term focused portfolio. One of the advantages of the Modern Investment Club is that by meeting once a month, you have time to digest short-term issues. And by the time the club gets around to meeting and talking about what's happened, the damage has been done, and at least on an initial basis for a company that has hit a stumbling block, and the club can then on a not on a knee-jerk basis, but on a considered basis, decide what to do with that particular holding. Now you can use your portfolio construction guidelines as fuel for decision making. Often the answers become apparent when you look at how your portfolio is out of balance, how you're overinvested in slow growth stocks, and so when those companies are not performing well, you've got ammunition to make the necessary changes to bring things back in line. I believe in the challenge approach. I believe in not selling simply to raise cash, but replacing stocks with better prospects on a regular basis by not waiting around when companies are disappointing you, no matter how long you've held them, 2 months, 3 months, 6 months, 5 years, companies that aren't working towards your collective portfolio goals should be replaced. The challenge approach is a great tool for that. All right, so let me double check on some of the questions here. Deborah asks, how do you determine the beta? On the beta report, in myICLUB, you'll see the beta for each security that has a 5-year trading history. And we only cover stocks with the beta, so other securities we don't have those beta available. They come from our data provider, but essentially they compare the volatility of each stock to the S&P 500. And over the last 5 years, when the S&P 500 goes up 10%, how much did this stock go up on those good days? When the market went down 10%, how much did the stock go down 10%? So it essentially tracks them and calculates that figure for us. So from there, we calculate the weighted beta, a figure for each security, and then we add them all together, and that gives us the weighted average portfolio beta figure. So this is pretty standard financial analysis tool. You can find beta by going to a site like Yahoo Finance, looking at the company page. It will tell you the beta of the stock on the last 5-year basis. I will note that in our portfolio report, we have a plan for those stocks that haven't been around 5 years to use a 3-year beta, but that's not been implemented just yet, but that is in the plan. So if you have a stock that's less than 5 years of public history, it's showing up as no beta available or 0.0, and that will change over time. Richard asks if there's a guideline regarding the ownership of multiple securities that individually garner more than 10% of your portfolio. There's one of the rules of thumb, and Russell has pointed out in his answer to you, but one way of measuring how much is too much of a single stock that you own is taking the equal weight of the entire portfolio of each holding in the portfolio. So if you have 10 stocks in your portfolio, each stock in that portfolio, the equal weight position would be 10%. And then anything that's more than 2 or 2.5 times that would be considered overweight, right? So any stock in that portfolio that has 20% of your total assets or 25%, again, depending on that, which version of the rule you want to go with, 20 to 25% would be overweighted. So in essence, it's saying that no security should be more than 2 or 2.5 times the equal weight position of the entire portfolio. So there are other methods, but that's one that is frequently brought up. Um, on a more casual basis, anytime a stock is above 20-25% of your total portfolio value, that's a very heavy weighting. Certainly 30%. Now we're getting into dangerous overweighting territory. Obviously, if you're just getting started and your entire club portfolio is 5 stocks, your average weighting might be 20%, and that's fine as you're building out. But for a mature portfolio, you wouldn't want to be overloaded too much above that guideline, I would think. All right. Uh, so Richard, I'll get to some of your questions. Al, we'll get to some of your questions later on. We're going to go ahead as we go through this club portfolio and take a look at these 3 portfolios. You'll get a sense of these rules in action and what my thoughts are on each of the portfolios. Now, I'm not going to address tax considerations, though. We will talk a little bit about it in one of the portfolios. I didn't look at the past performance. Again, that's irrelevant to what might happen in the future, but it's not irrelevant to your club portfolio management in terms of capital gains and realizing them, capital losses, et cetera. I'm not going to look at fundamental problems. I didn't do SSGs on every stock that was covered. A lot of them are very familiar names. Fundamental problems are easy to spot. When you've got fundamental problems, my advice is not to sit around and wait to see what might happen. Have a plan, have an exit strategy, have a challenge mentality so that any signs of weakness, you can look to see if there are other companies that might be good replacements, but never default to hold just because you don't know what to expect. And these are specific to clubs. Often these guidelines will impact individual investor portfolios in much the same way, but there are some different considerations, and individuals often don't face the same constraints. There's no one size fits all, so I'm giving you a bunch of ideas that you can incorporate, that you can talk about, that you can review. Certainly, a club of 20 and 30 something young professionals might have a different idea of risk in the market than a group of 60, 70-year-old retirees and near retirees, and might invest differently. There are all sorts of other factors that can come to play. I'm going to provide comments that are either good cautions or warnings. Don't worry about, but I often don't point out all of the good things. So point out the highlights, and the cautions are things to watch out for. The warnings are areas where action might be more called for. There are few absolutes, but hopefully these will provide some talking points, and your club can help to articulate its approach and make improvements in your portfolio. I really believe that having practical goals is more educational and works to the portfolio's benefit, instead of saying, anybody have any stock ideas for next month? Okay, but if you say we need mid-sized industrial or basic material stocks, so let's go out and see what we can find in those areas that would complement our current portfolio, improve our diversification by size and industry sector exposure. Right now you have something tangible that members can look for and find the best of the best opportunities that are available. So Jabez Ladies, hope I'm saying that right, 19 members, founded in 2017, located mostly in Delaware. They own 14 companies. Holding more than 14 companies could be good. They've got 19 members. Certainly, each member could follow one stock, and they could add a few more companies to the portfolio, and that would perhaps improve their diversification. the portfolio holdings here. Here's the list of the companies I've highlighted in yellow. Some areas in which some attention might be paid. There's no arcane or particularly problematic investments here. There's no limited partnerships or real estate investment trusts. The cash is a little high at 7.7%. Part of that is a CD that I presume they're locked in with. Not a big fan. Having 7% of your assets working in this record-breaking bull market where you've got a big chunk of cash that's not working. There are always opportunities to invest out there. I know, and this is, I think that's net of a pending withdrawal. There's one slightly underweight position, that direct digital, direct TV, holding at 2.4%. That's a little low. But I also understand, that's always the question. If the holding is low, but it's not in the buy zone, it can be difficult to make that decision to bump it right up. That stock may have some fundamental issues. It's not quite, may not be performing quite as well. I would take a look at a stringent SSG on that one to decide if that's really something that you want to hold. And I do note I was following the Duckhorn portfolio. This is a winemaker. Their ticker symbol is Napa. And just 2 weeks ago, they agreed to be acquired. They were selling at $5.80 a share. Now they're at $10 and just under $11 a share, based on the buyout price expected to be completed this winter. So that's a significant up. Almost doubled in price in the last couple of weeks. My suggestion when this scenario happens is that assuming that your holding period, that you're not okay. My recommendation, when you get an acquisition offer like this, what's going to happen is you're going to get paid cash. So it's going to be just like you sold it at the end of the day. Now the $11.10 a share is the offer price. The current price is something like $10.97. So it could take 3 months or more for this deal to come through, and at that point you would only make 13 cents a share for 3 months. I feel like you could, I think that you could find some better opportunities that would deliver a rate of return that's greater than that and use that cash now. The thing to look at is what's the holding period. Well, in your case, waiting until January doesn't change your holding period. There would be short-term capital gains. So there's no point in not selling now, waiting until you get the cash from the company. You might as well sell it, take the money, reinvest it, instead of having that cap on the potential returns if you wait for the buyout to complete. If the buyout doesn't complete, if the board rejects the offer, if the shareholders reject, if for some reason it falls through, well, the price is going to come back down to that $5.80 level probably, and you could buy more shares at that point if you really wanted to hold it. There would be no penalty for you. You'd be selling at a gain right now, so you would be able to repurchase it at the lower price, and you would have just booked a significant amount of profit. So that's one of my key recommendations. For a cash buyout, it's not such a big deal, but often you get these complicated scenarios where the company is you're gonna get some cash and you're gonna get some shares of the acquiring business, and your basis is gonna need to be adjusted, and you're gonna have, maybe they're gonna pay you a dividend as well. It gets so complicated that it gives the treasurer all sorts of challenges in recording it, where if you just sold it and took the profit and reinvested it, you'd be better off. Usually what happens in those cases, you end up with a company owning shares of a company that you don't want to own. So why put yourself through that? But with this one, it's pretty straightforward. Assuming the deal's approved, you're going to get $11.10 for cash. If you can sell it right now for $10.90, I say and it's not going to impact your holding period, I say go ahead and do it. So that's how I like to handle these types of mergers. By company size, there are no mid-sized companies in the portfolio at all. The purple is the mega, the blue is large, the darker blue is the large, small companies are in green, the micro company is in turquoise, and the CD isn't showing up as cash because it's listed as a security, and that is in gold there. So mega and large definitely overrepresented. Small, is not too far. It's about half of what it would ideally should be, but you've got 1, 2, 3, 4, 5, 6, 5 companies in the small micro category. So, I see that you're making efforts there. And some of those companies that we've covered or do cover in the small cap informer. So that's good to see. On the super sector side, it's pretty good. Defensive super sector 21% is very high. It's often difficult to find utility, healthcare, and consumer defensive stocks that kind of fit the better investing model. So that's looking pretty good. I like that diversification. The semiconductor industry group at 24% is overweighted, and that's due to some overlap of NVIDIA and Qualcomm. To companies in that semiconductor industry. And so, I don't like to see that kind of overlap. So besides the overlap, you've got 2 companies in the same industry group. All sectors are represented in the portfolio except basic materials. That's pretty good. You can see the internet retail is a little bit high at 18%, but otherwise all those slices of pie are looking pretty good, and that CD is popping up again as keeping that money out of the market. By earnings per share growth rate, the faster growing companies are making up the bulk of the portfolio, those with projected earnings growth rates greater than 12%. That's in green. The slowest growing companies are in light blue, less than 7%, and 7 to 12% earnings projected growth in the orange. The club is using the linked SSGs for the growth projections for most of the companies, but not necessarily all of them. So not some consistency there, but the sales growth rate diversification is pretty similar. So good there for at least looking for the growth. And then the portfolio beta comes in at 1.11. Again, there are some securities here where the beta can't be calculated for, but that 1.11 level is right in line with my loose target of 1.1. So that means this portfolio's got the oomph, it's got the horsepower to outperform the market based on the historical tendencies of these particular companies. So all in all, $120,000 portfolio. I think it's a few tweaks here and there, resolve some of the, your cash holdings, figure out what you're doing with a CD, I think will have the potential to drive some more improvements as you head into 2025. So let's keep going. We'll take a look at FEM Unlimited, FEM Unlimited, 25 members, 28 companies located in California, founded in 2000. 28 companies, that's within my 20 to 30 company range. So that's pretty good. 25 members can definitely support a portfolio of 28 companies. This club has been watching the webinars, and since our last portfolio tune-up, they reduced the number of securities from 45 to 28. So I see it as a work in progress. They've got a major holding, however, in QQQ, and we'll talk more about that. That's the NASDAQ 100 ETF, and they've indicated they are thinking that they should sell it, but they've got a lot of capital gains, and so we'll talk a little bit about some strategies for that as we look through it. Here's the portfolio holdings. In yellow are primarily the underweight positions. There's 17 different securities that have positions below 3%. So to me, that's saying these are not providing optimal levels of exposure to the fundamental trends that are going to drive the portfolio. The QQQ ETF makes up 4.6% of the entire portfolio. We'll talk more about that. Cash is good, hardly any, 0.5%. There's some overlap. Walmart and Costco are both in the discount stores category of the consumer defensive stocks. So there's significant overlap there. And I know what you're saying. Yeah, but Walmart and Costco, could they be any more different? But remember that Walmart has the Sam's Club business, which is a direct competitor of Costco. So there are a lot of economic factors that are going to impact both of these companies to a similar basis. And so you want to watch when you're overlapping both of them. Personally, I'm not the biggest fan of Walmart from an investing perspective, but they are a major player in the retail economy. Intel, INTC, and NVIDIA also have significant overlap, both chip makers. Berkshire Hathaway and Travelers also have significant overlap, although in both of these last two cases, one of the companies is, is a small percentage. Intel, 0.4%, Travelers, 0.3%. So the fact that Travelers, a property and casualty insurance business, overlaps with Berkshire Hathaway, which has Geico and other insurance businesses as part of its core holdings, is something to keep out for. We want you to find the best and invest in the best. Intel and Facebook, just as a note to the treasurer, both of them were included twice. It just kind of complicates things, but I've added them together on this table here to show you, to calculate the total exposure to those companies. By company size, there are no small companies. There's one micro-sized company that is a sliver that's too thin to really appear, 0.1%. There are two mid-sized companies that total 3.9%. That's the orange slice. The rest is mega and large. And QQQ is mostly mega and large as well. So that altogether, something like 97% of this portfolio is large and mega sized companies. So probably has performed well in the last couple of years, but during a bull market or during a bear market or market correction, we would expect this portfolio to maybe take a bigger hit than if it was more broadly diversified by company size. By super sector, again, pretty good allocation here. The defensive super sector is at 12.3%. That's slightly light. My target is, I like to see about 15%. So it's a little light, but at least you've got some exposure there. The sensitive and the cyclical, I'm ambivalent on how you decide to break up those and get your exposure across them, those two super sectors. By sector and industry, again, when you look at these charts, the big slices of pie are areas of potential concern. All sectors are represented except basic materials, so that's good. The technology sector, if we assume that the QQQ is mostly technology, although it's not absolutely all technology, that takes your total technology weighting of this portfolio to something like 34%. So that's a very tech-heavy portfolio. If that's the design and the intention, that's good, but that can also lead to uncomfortable volatility. The healthcare sector is incredibly underweighted at 1.9%, one drug maker stock, one medical device stock, both of them around 1%. Again, I think healthcare is an area where a long-term investing portfolio should have exposure. So at 1.9%, I think that's a little low and might be a good objective to increase that. Increase your healthcare exposure will increase your defensive exposure. There are plenty of smaller mid-sized companies in the healthcare industry that provide opportunities. By growth rate, again, the green pie, the green area in the pie chart, the green slices are the companies with projected earnings growth greater than 12%, but no SSGs are linked, so this is using analyst estimates, which may skew things a little bit. Sales growth diversification looks very similar to this, so again, good for going for the growth here. Portfolio beta now for this portfolio 1.23 compared to 1.11 for the prior, so this one has a higher degree of potential volatility, if you will, compared to the first portfolio. In part, that could be from the when you look at the 5-year betas here in the table, you'll see companies like NVIDIA, Meta, Netflix, Apple, Amazon, Facebook, Alphabet's, Google's beta is actually pretty low, 1.04. Lower than you might think, but there are a lot of companies there with higher betas, and that's going to, and because of the heavy exposure there, that's going to drive that beta a little bit higher. I think as you diversify the portfolio, that figure might come down a little bit. So let's take a look at QQQ. I've highlighted the stocks in the portfolio that are also in the QQQ ETF in the NASDAQ 100. 57.6% of the portfolio by weight, those 9 companies are also in the QQQ. So that means each one of these has additional exposure in the QQQ. And that's one of the reasons I'm not a big fan of ETFs and mutual funds, because Apple is the biggest stock in the QQQ. It's also one of the biggest stocks in this portfolio. When you add the two together, now you've got more exposure to Apple than perhaps you thought you did as you went through. So QQQ in this club's portfolio is a long-term holding. I think it goes back to 2000, probably when that QQQ was a new offering on the markets, and they have this is a mature club. They've got $65,000 of unrealized capital gains. If they were to sell today, that's how much they would be. Their members would be liable for capital gains on the sale. So obviously, the club would not like to pay all those capital gains, but how could they reduce the exposure? How can they maintain a focus on individual stocks? So I don't think they necessarily need to sell, or certainly not all at once. So here's some ideas for dealing with it. We talk about, and Richard asked in the chat about capital gain loss harvesting. So if the club has incurred capital losses so far, they've cleaned out a bunch of stocks, so there must be some capital losses. Maybe there's some capital losses. And so I took a look at the club's history, and yes, they sold a lot, but they have $30,000 already incurred this year in capital gains, net capital gains. Some were sold at a loss, but a lot of stocks have been sold at gains, so $30,000. So that's a lot of capital gains to be distributing to partners. They also are holding securities, primarily Intel and that QXO, with $12,000 to $13,000 in unrealized losses. So that's a no-brainer to me. QXO is not investment grade, I don't think. Intel, you'll have opportunities to buy Intel if you want, but it already overlaps with NVIDIA. So selling those securities right now and incurring $12,000 to $13,000 in losses will offset those $30,000 of realized gains already incurred for the calendar year 2024. I think that's a pretty good idea. And I can't see the Intel or the QXO are such small positions. It's not going to have any sort of negative impact, and will actually probably have a positive impact on the diversification. And if anybody resists it, you can revisit that sell decision in 31 days. You got to avoid the wash sale rule, but you can come back in 31 days and use cash on hand or other securities sell other securities and purchase the Intel and the QXO if you wanted to. My sense is that's probably not the smartest approach to handling the realized gains. But that also means that you don't have any opportunity to sell to sell QQQ this year, you've already got there's no capital losses left in the portfolio. So selling QQQ would give you would require generating some capital gains. So here's some strategies. One, you could continue to hold it, right? But just bear in mind that QQQ is a tech-heavy index. You can get a listing of the QQQ holdings, what those 100 stocks are in the QQQ and what their weight is. And when you're in the rest of your portfolio, if QQQ is tech heavy, make that the proxy for a big chunk of your tech exposure, and then go outside of tech in the other parts of your portfolio. I like to say think of when you're dealing with overweighted holdings in your portfolio, that it can be hard to winnow those down. Another strategy is put new capital into other industries and sectors that are sort of the opposite of technology. So what's the opposite of technology? Well, I don't know, basic materials, industrials, consumer defensive, those types of companies, and work on that, growing that aspect of the portfolio, and that will provide the balance to the tech and large cap exposure in QQQ. Look for smaller and mid-sized companies. If you have members that are withdrawing, you can transfer shares of QQQ just like transferring shares of security to them instead of cash. And that's another way of winnowing down. The capital gains from those transfers get held in the club's books and then distributed to the remaining members when those members withdraw. Could be 3, 5, 10 years down the road. So you're deferring those capital gains, and that's a good thing. And if you have future portfolio decisions and you make a purchase and it doesn't work out and you're down 20 or 30% and you're thinking, what should we do? That's a great time to sell an equal amount of gains out of your QQQ position when you sell the losses out of your the underperformer, so that your net capital gains are roughly zero for the year, and just manage those gains and losses as you go, and that would gradually help bring down that QQQ position. You can bite the bullet and get rid of it all on January 2nd, January 3rd, whenever the market opens next year, and not have to worry about the gains for another year. I don't necessarily think that's entirely required. This is obviously a decision that's gone back 20, 25 years to buy it. It's got a phenomenal amount of return embedded in it. So, if you acknowledge it and keep it part of your core holdings, but just invest around it, that could be a valid strategy. So definitely some food for thought there. All right, we got one more portfolio, one more club portfolio. It's called, the club is It's Our Turn. 6 members, 8 companies, founded in 1997. They're in Washington, so obviously a longstanding club. They've probably lost some members, and their portfolio has come down along the way. Obviously, an 8 stock portfolio is not very diversified. So, I presume this club would be working towards building up that portfolio. Here's their holdings. There are 2 overweight positions, what I would call Apple and Amazon, both at 29.5 roughly percent of the portfolio. So, almost 60% of the portfolio is in those 2 stocks. Great companies, that's a lot of weighting in 2 stocks. However, 2 significantly underweight positions, below 3%, the Amphastar Pharma and Google at 0.9 and 1.3%. Again, at those levels, those are can perform well and not have any impact on the bottom line, so to speak. No arcane or problematic investments. US Lime is a company that I follow. It's a commodity, so it's really, anti-technology in many ways. Never been compelled enough to invest in it. And the other names you're probably all familiar with the exception of perhaps Amphastar. Cash is good at 0.6%, so this club is fully invested. By company size, that skews towards mega and large. There's a couple small companies there, two small companies, nothing in the mid-size range. So we would say that mega and large are overrepresented in this portfolio. By super sector, again, consumer defensive super sector the defensive super sector is underweighted at 6.7%, and thus the sensitive and cyclical super sectors are overweighted at about 46.5% each. Again, this gives you a goal. What can we do to improve the defensive exposure of this portfolio? By sector and industry, you can see some big pie slices here. All sectors are represented except industrials, interestingly enough, so that roughly each of the companies is in a different sector, and that's pretty good. The healthcare sector is underweighted at 0.9%. So again, that's an opportunity to go shopping for healthcare stocks. Tech and consumer cyclical are overweighted, and internet retail industry and consumer electronics are also overweighted. And those are just because of the two companies that are make up the bulk of the portfolio. By growth, yeah, the faster growing companies making up the bulk of the portfolio. That green, those are companies with projected growth rates of greater than 12% for earnings. About half of this club stocks are using linked SSGs, so they're using the members' growth projections as opposed to analyst estimates. And the sales growth rate is showing similar diversification. The beta here, 1.07, that rounds up to 1.1, so that's pretty good level, I think. Might be a little low. Again, the emphasis on large company stocks may be holding that back a little bit, but that gives you just a sense of how the portfolio weighting all comes together by security there. So I think all in all, that's a pretty good looking portfolio. As the portfolio again, I don't know the decisions that go into when you're looking at Apple and Amazon, those large positions, how far back they go. Again, more issues with embedded unrealized capital gains that make it difficult to kind of pare those down. But there seems to be a lot of opportunity to find interesting small and mid-sized stocks for all three of these portfolios. And again, I think those benefits over time can really help drive portfolio return and reduce the overall volatility in the portfolio. It's an interesting thing. Add more stocks that are not like the others, and the entire portfolio improves. So with that, if you need more stock ideas, we're making newsletters, we're making screening tools, so there's plenty of opportunity to answer the question, where can we find good stocks to study? The tools that we make are designed to help you with that task. The 3 newsletters now that we produce, the Small Cap Informer, the Investor Advisory Service, and the Dividend Informer are all available. If you use the promo code Doug's Deal on the Small Cap Informer Investor Advisory Service, you can get a pretty optimal rate. And the Dividend Informer is still open to subscribers at the charter rate. This is not a yield newsletter, but a long-term focused total return newsletter that seeks to find stocks that have good capital policies of paying dividends, paying off debt, buying back shares, providing lower levels of volatility for investors in the later stages of their personal investing journeys, where they want to ratchet back a little bit of the growth, but still focused on total return over time. So other questions. Richard says, is there an Excel exporting ability in myICLUB? Any report that you can see on the site, if you click the print version, not the PDF version, but the print version, it'll pop open a plain HTML window, and that table can be copied and pasted into an Excel workbook, and will give you access to everything in the table. That's the most expeditious way to get access to the data in the reports if you want to use it in Excel. Al says that they from the last club, they look like they're going to be selling quite a bit of their large holdings as one member is withdrawing, who represents about 35% of the portfolio. Again, if you can transfer shares of those highly appreciated stocks instead of selling them and incurring capital gains, your remaining members will not have a big tax bill this year. Their tax bill will come at some point down the road. So highly recommend looking at transferring appreciated shares to fully withdrawing members if possible as a strategy there.
Doug, I just want to
Yes,
add,
Russell, go ahead.
there's tax benefits to the receivers of those transferred shares too, because they can defer gains from their club investment by receiving shares instead.
Yep, it's a win-win situation if you can transfer appreciated shares to fully withdrawing members. We've done webinars on it. You can find in our archives, and we've got help documents that will help you through it. And the withdrawal scenario calculator in myICLUB will help you find the optimal solution for any partial or full member withdrawal using transferred shares or paying off with cash, and how to raise the capital for that cash payout by selling depreciated shares, and how to avoid strategies that don't work out optimally for the remaining members. Bonnie says that Schwab does not let you transfer stocks. Yep, if you have a Charles Schwab account, you are kind of stuck because the Schwab does not permit transferring shares out or cash out to any member of the club. And so a lot of clubs are switching from Schwab because of that prohibition and restriction that Schwab currently has. Well, with that, thank you. Thanks, Treva and Russell and Sean in the back office. Thanks for your questions and for attending. We'll be looking forward to seeing you next month in November. We'll be, we've taken our conducting a year-end audit portion of our closing the books presentation out. We're going to be doing a standalone webinar next month at this same time slot on conducting the year-end audit of the club's books. So we'll go through the options, the permutations. We've got an updated audit worksheet that you can download and you'll be able to use after that presentation. It's an important part of making sure that the books and your transactions are sound. So we hope to see you then in November. So stay tuned. We'll provide more information on our complete schedule of upcoming webinars and what's new for the 2024 tax season. We've got plenty of new features and functionality that we need to talk about, some new requirements as well. So lots coming up in the next couple of months for investment clubs, but I want to thank you again for joining us tonight, and I wish you all the best as the year end starts to arrive, as you are working on your club portfolios and taking advantage of opportunities to harvest gains and losses and improve the return and risk potential of your club portfolio. Plenty to keep you busy. Thanks again. We will see you next month at our next myICLUB Investment Club webinar.